Hey there. Ever feel like the world is one big fasten your seatbelt sign?
Yeah.
Well, buckle up because
Right.
Goldman Sachs, the Wall Street giant,
hmm
just released a report that has the markets buzzing,
Right. Yeah.
and it's all about a potential gold rush.
It is. It's not exactly pickaxes and pans,
Right.
but the sentiment is definitely reminiscent of those gold rush days.
Okay, so we've got this report predicting a gold price surge. But before we get into the nitty-gritty, paint the picture for us. What's the current state of the gold market?
Yeah. So gold's been on a tear this year. We're talking a 20% increase already, which is significant in any market.
Yeah.
Goldman Sachs is forecasting that this upward trend will continue with gold potentially hitting a record-breaking $2,700 per ounce by early next year.
Wow. That's a massive jump. What's fueling this bullish outlook on gold? It feels like everyone's suddenly talking about it.
They are. There are a few key factors driving this prediction. One major one is the unprecedented buying spree we're seeing from central banks around the world, particularly since the war in Ukraine began. They're essentially accumulating gold reserves at a rate we haven't seen in decades.
That's interesting. It's like they're preparing for something big. Is this why some analysts are calling gold the new safe haven asset?
Exactly. See, central banks are always looking for ways to diversify their reserves and mitigate risk.
Right.
Traditionally, they favored assets like U.S. Treasury bonds.
Yeah.
But in a world grappling with geopolitical uncertainty, inflation, and the potential for a global economic slowdown, gold is becoming increasingly attractive.
So it's less about gold suddenly becoming more valuable and more about it being perceived as a reliable store of value in uncertain times. Like that old saying, when in doubt, go for the gold.
Precisely, gold has this historical allure as a safe haven asset. It's tangible, it's finite, and it doesn't rely on any single government or financial system.
Okay, so central banks are buying up gold like it's going out of style. What else is contributing to this potential gold rush?
Another significant factor is the anticipated shift in U.S. monetary policy. Remember how the Federal Reserve has been aggressively raising interest rates to combat inflation?
Right, everyone's been feeling the pinch of those rate hikes.
Well, the market is now expecting the Fed to ease up on those rate hikes, possibly even starting to lower rates sometime next year.
Hmm.
And historically, when interest rates fall, gold tends to benefit.
That makes sense. Lower interest rates mean the return on other assets like bonds becomes less appealing, making gold, which doesn't pay interest,
Yeah.
but tends to hold its value,
Yeah.
a more attractive option for
You
investors.
got it.
Too.
So you've got central bank demand, potential interest rate cuts on the horizon. And let's not forget the ever-present geopolitical risks that tend to push investors towards safe haven assets like gold. It's creating a perfect storm for a potential surge in gold prices.
It sounds like all signs point to gold being the it investment right now. But let's zoom out a bit. Is this just a gold rush or are other commodities part of this narrative?
That's a crucial question. While gold might be grabbing the headlines, the outlook for other commodities is far more complex and less optimistic.
Okay.
Take oil, for instance. The report suggests some headwinds for the oil market, with slowing demand from China being a major factor.
Interesting. China's usually the powerhouse driving demand in so many markets. Why the slowdown there?
It's a combination of factors. Their economy is experiencing a slight slowdown after years of rapid growth, plus their push toward renewable energy and electric vehicles is starting to impact oil demand. On top of that, the U.S. is producing more oil than anticipated, further complicating the supply and demand dynamics.
So it's not all sunshine and rainbows for oil. How about other commodities? Are they facing similar challenges?
The report paints a mixed picture. Some industrial metals like copper and aluminum are also facing headwinds. While they're essential for everything from construction to electronics, global demand isn't quite keeping pace with production. This is putting downward pressure on their prices, making them less attractive compared to, say, gold.
It's fascinating how the fates of different commodities can be so interconnected with global trends. While gold is potentially thriving in this environment of uncertainty, other commodities like oil and some industrial metals are grappling with their own set of challenges. It sounds like investors need to be very discerning right now, carefully evaluating the individual factors influencing each market before making any decisions.
Absolutely. Don't let the glitter of a potential gold rush blind you to the complexities of the broader market.
Right.
There's a lot more to unpack here.
Okay, then, let's unpack it. This Goldman Sachs report has thrown a spotlight on the bigger economic picture and the forces shaping the markets. Before we get into those details, though, let's take a quick break. We'll be right back to delve deeper into this fascinating topic. Don't go anywhere. And we're back. Before we touched on how central banks are turning to gold as a safe haven, but I'm still thinking about that intriguing phrase from the report, Fed subordination risk. It sounds like something out of a political thriller.
It does have a certain ring to it, doesn't it? But it's a very real concept with potentially significant implications for the markets.
Could you break it down for us a little further? What exactly does Fed subordination risk entail?
Essentially, it refers to the risk that the Federal Reserve, which is supposed to operate independently from political influence, could be pressured to prioritize political objectives over its core mandates of maintaining price stability and maximizing employment.
So instead of making decisions solely based on what's best for the long-term health of the economy, the Fed might be swayed by short-term political pressures.
That's the concern. Imagine a scenario where the government wants to pursue policies that could potentially fuel inflation, perhaps to boost short-term economic growth. The Fed, recognizing the long-term risks of unchecked inflation, might try to counteract those policies by raising interest rates. However, if the government leans on the Fed to hold back on those rate hikes, it could undermine the Fed's credibility and independence.
And that erosion of trust could have a ripple effect throughout the financial system, right?
Precisely. Investors rely on the Fed to act as a steady hand, making rational, data-driven decisions. If that trust is shaken, it can create uncertainty and volatility in the markets. Investors might start questioning the stability of the U.S. dollar, leading them to seek out alternative assets that are perceived as safer and more resilient during turbulent times.
And that's where gold comes back into play. If investors lose faith in the dollar, they might flock to gold as a more reliable store of value. It's like a financial security blanket in uncertain times.
That's the historical pattern, at least. Gold has this inherent value that's not tied to any particular currency or government. It's a tangible asset with a limited supply, which makes it attractive during periods of economic or political turmoil.
So this Fed subordination risk, while seemingly complex, boils down to a simple idea: trust. Trust in the system, trust in the institutions that govern it, and the potential consequences when that trust is eroded.
That's a great way to put it. And the fact that Goldman Sachs is highlighting this risk in their report speaks volumes about the current state of the markets and the level of uncertainty investors are grappling with.
Absolutely. It's a reminder that the financial world is not just about numbers and charts. It's influenced by human behavior, political dynamics, and a whole host of intangible factors.
Exactly. Understanding these intricate connections and underlying forces is key to making informed investment decisions. It's not just about chasing the latest hot tip or following the crowd. It's about developing a nuanced perspective on the market and making calculated choices that align with your own financial goals and risk tolerance.
Speaking of nuanced perspectives, it's interesting to note the contrast between gold and other commodities in this report. While gold seems to be riding a wave of uncertainty, other commodities are facing a more challenging outlook.
That's a very astute observation. The report highlights the divergent paths of different commodities reflecting the complex interplay of global economic forces.
For example, we talked about how oil is facing headwinds from slowing demand in China and increased U.S. production. It seems like the energy transition with the rise of renewables and electric vehicles is starting to have a real impact on the oil market.
Absolutely, and those trends are unlikely to reverse anytime soon. The global energy landscape is undergoing a profound transformation, and investors need to be mindful of these long-term shifts when considering oil and other traditional energy commodities.
The report also touched on the challenges facing industrial metals like copper and aluminum. They're essential components in so many industries, but it seems like global demand isn't quite keeping pace with production.
That's right. The slowdown in China's economy, coupled with ongoing supply chain disruptions and the lingering effects of the pandemic, have all contributed to this softening demand for industrial metals. This is in stark contrast to the situation with gold, where demand is being driven by safe haven seeking and concerns about global instability.
So we have this interesting dichotomy: gold perceived as a haven in uncertain times, and then a whole range of other commodities grappling with their own unique set of challenges, from slowing growth to technological disruption. It's like each commodity has its own story to tell about the state of the global economy.
That's a fantastic way to put it. It underscores the importance of doing your due diligence and understanding the specific factors driving each market before making any investment decisions. There's no one-size-fits-all approach here.
Speaking of due diligence, I recall the report cautioning against blindly jumping on the commodities bandwagon as an inflation hedge. Why is that?
It's tempting to view commodities as a simple solution for hedging against inflation. After all, if the price of everything is going up, the thinking goes asked. then the price of raw materials should too.
Right. It's like the age-old advice, buy land, they're not making any more of it.
Yeah.
But in this case, it would be buy gold, oil, or copper because their supply is limited.
Exactly. But the reality is far more nuanced. While commodities can be a valuable part of a diversified portfolio and may offer some inflation protection, they are not a guaranteed hedge.
So just because we're seeing inflation doesn't mean every commodity will automatically go up in value.
Precisely. There's a multitude of other factors at play. Supply and demand dynamics, technological advancements, geopolitical events, and even government policies can all impact commodity prices, sometimes in unpredictable ways. For example, advancements in renewable energy might decrease the demand for certain metals used in traditional energy production.
It's a complex web of interconnected factors, and assuming a simple correlation between inflation and commodity prices could lead to misguided investment decisions.
That's the key takeaway. It's vital to approach commodities investing with a discerning eye. Considering the unique factors driving each market and understanding the risks involved.
So while it might be tempting to get caught up in the excitement of a potential gold rush, it's crucial to remember that informed investing is about more than just chasing the latest trend. It's about carefully evaluating the information at hand, understanding the broader economic forces at play, and making strategic decisions that align with your own individual financial goals.
Well said. A thoughtful and informed approach is always the best strategy, especially in times of market volatility and uncertainty.
With that in mind, let's shift gears slightly and explore another fascinating aspect of this report: the potential for unexpected consequences, even from seemingly positive developments. We've talked a lot about gold and all the factors that are driving its surge in price, but this report also hints at something that could really shake up the energy market. It involves something called liquefied natural gas, or LNG for short.
Yeah, that's right. The report predicts a big surge in global LNG supply starting around 2025. And this is largely due to new export projects coming online, particularly in the United States and Qatar.
Okay, so more LNG is entering the market. What does that mean for the average person? Lower energy bills, maybe.
Well, it's not quite as simple as that. Increased supply often leads to lower prices, but the global energy market is incredibly complex. You
Right.
got geopolitical factors, transportation costs, and even weather patterns. All of these things can influence prices.
So it's not a guaranteed win for consumers, but it could maybe ease some of the pressure we've been seeing on energy prices.
Yeah, potentially.
Yeah.
But what's maybe even more interesting is what impact this LNG surge could have on that global energy transition we've been talking about.
That's right. We talk about the energy transition as a shift from fossil fuels to renewables like solar and wind. How does a natural gas boom fit into that?
That's the big question, isn't it? If natural gas becomes more abundant and cheaper, it could complicate that transition to renewables.
Okay.
Some countries might choose natural gas as a sort of bridge fuel, a cleaner alternative to coal in the short term that could delay that full-scale move to renewables in the long run.
So it's not just about the price of energy, it's about the choices that countries make and how they're approaching a sustainable energy future.
Exactly. It shows how developments in one area of the market can have ripple effects across that entire energy landscape and even beyond that.
It's really a lot to think about. We've covered so much in this deep dive, from the potential gold rush to the complexities of the Fed, from the challenges facing other commodities to the potential shakeup in the energy market with this LNG surge. It's clear that we're living in a time of extraordinary change and uncertainty.
We are. And while no one can predict the future, staying informed and thinking about these things like we've done today is really important for navigating these uncertain times.
Absolutely. This Goldman Sachs report has given us a lot to consider, but it's only one piece of a much larger puzzle. As we keep going through this complex and always evolving economic landscape, what key takeaways should we keep in mind?
First and foremost, diversification is key. Don't put all your eggs in one basket, as they say. Spread your investments around into different asset classes, including stocks, bonds, real estate, and even commodities, but always with a thoughtful strategy.
Don't get blinded by the gold rush.
Exactly. Second, stay informed. Keep your finger on the pulse of global events, economic trends, and geopolitical developments. The world is constantly changing, and what worked yesterday might not work in today's market.
Knowledge is power, right?
Yes.
Any final thoughts you'd like to leave our listeners with today?
Don't be afraid to ask questions and challenge assumptions. The financial world can seem intimidating, But the more you learn and understand, the more confident you'll become in making decisions that are right for you.
Those are wise words. A huge thank you to you for guiding us through this fascinating deep dive. Your insights have been invaluable.
It was my pleasure.
And to all our listeners out there, thank you for joining us on this journey of exploration and discovery. Remember, the world of finance is always evolving, and so are the opportunities to learn and grow. Until next time, keep exploring, keep asking questions, and keep diving deep.